So, question back from a client. Now that the bank base rate has come down, what can I do about my mortgage, especially from first-time buyers and remortgagers? So, now that the recent Bank of England base rate cut has come out, this is actually the first cut since 2020. Good news for millions of homeowners and potential buyers. It's a step in the right direction, but it also raises some important questions, I feel. If you're looking to buy a home, you might be wondering what sort of mortgage to go for. Rates are still quite high, and is this rate cut going to push house prices even higher? Will it sort of increase demand for properties? And for remortgagers, if your existing mortgage deal is about to end, you may be wondering, should you grab another deal now or wait for potentially cheaper options? So a few questions come up. The cut has come from 5.25% to 5%. It should translate into lower borrowing costs for homeowners with a base rate tracker mortgage, for instance, straight away. Or if you've come off a fixed rate and you're already on the lender's SVR, then you should see a slight drop in your monthly payment. The challenge is that almost 7 million of the UK's 8.4 million existing residential mortgages are on fixed rates, so those people are not going to see any changes immediately. Many will need to consider their options in the next few months as their current deals come to an end. So if you're buying a home, should you go for a fixed rate or a tracker? That's the question that most people are asking. Both have their advantages. A fixed rate mortgage offers the certainty of set monthly payments, hence the reason it's called fixed. This is usually crucial for those whose finances are tighter. Many first-time buyers are really pushing out the boat, so they tend to go for fixed. However, most experts are predicting more interest rate cuts, probably at least one more before the end of the year. So some borrowers might lean towards a tracker to benefit from lower payments in the future. So, with a tracker rate, the interest rate reflects the bank of base rate. So if base rate's going down, then your tracker will go down. Fixed, the benefit is certainty of payments. Fixed rates are also a lot cheaper at the moment than trackers. Trackers haven't moved down massively. The good news for those favouring a fixed rate is that new deal rates have definitely been coming down. Recently, some 5-year fixed rate mortgages for house purchases are even below 4%, and we haven't seen that for at least 9 months at least. Nationwide's offering 3.99 for a 5-year fixed at the moment, but that's at 60% LTV. Virgin has a 5-year fixed at 4.76% on a 90% deal. 5-year fixed deals are definitely cheaper than 2-year ones at the moment, but some buyers might still prefer shorter term because they are hoping for interest rate cuts after 2 years. And those considering a 2-year tracker, the rates are high. Barclays is charging 6.1% at the moment, and Halifax is pretty similar as well. So it might take at least 3 base rate cuts for the trackers to become cheaper. So fixes are definitely looking cheaper, and a lot of people are saying, so just wait to see what happens. I think rates will continually drop gradually, but if house prices keep rising, then any gain from lower mortgage costs could be cancelled out by higher property prices. So in my opinion, while the rate cut might lead to better offerings, don't expect huge downward spirals. For house hunters, waiting might mean higher property prices, so it may still be better to act quickly. As demand increases, it's just going to turn into a seller's market. So that's the issue there. For remortgagers, still plenty of challenges ahead. I mean, like I said, 700,000 people with fixed rate mortgages expiring between July and December. So in the next 6 months, most are going to face higher monthly payments. The average new 5-year fixed rate mortgage was 5.38. And when they went on their 5-year fixed in the beginning, it would be 2.8, so they're going to still see a 3% increase potentially. So if the cost of new deals drops, you could see what's available, lock in a rate, and then before you sort of press ahead, you could basically check again. I would just keep an eye on the rates at the moment, talk to a broker, get them to do some quotations. If you don't lock into a new deal, you're going to go onto the SVR, and that can be quite painful. Last week, the average SVR was around 8.16%. Some lenders charging even more. And being on an SVR could cost you a lot, especially if you stay on it for a while. So generally, I would advise against staying on the SVR for longer than maybe a couple of months. But just keep looking at what deals are out there. If you think fixed rates are going to drop sharply, maybe go onto a tracker with no ERCs, and just check that the sort of arrangement fee doesn't cancel out any savings you may potentially make. So go for a tracker with a low arrangement fee. Just factor in the arrangement fee when deciding. So I think there you have it. You know, the recent rate cut does present opportunities and considerations for home buyers and those with existing mortgages. It's not massive decreases, but just stay informed and consider your options carefully. Feel free to contact me for more personalized guidance, and thank you for watching.